If you've ever done any of your own retirement planning or watched any YouTube videos on the subject, you might be familiar with required minimum distributions. That's the amount that you're required to start taking out of your pre-tax retirement accounts like IRAs, 401ks, etc., so that the IRS can start collecting their tax revenue on that. You might also be aware that RMDs can cause some big tax issues for some people later in life. Depending on how much you're required to take out, it could push you into a higher tax bracket, cause Social Security to be taxable, and even cause Medicare surcharges. A common way to reduce the impact of RMDs is to do Roth conversions, since Roth accounts grow tax-free and are not subject to required minimum distributions. Because of those two facts about Roth conversions and Roth accounts in general, I think a lot of people have gotten carried away with doing Roth conversions. So in this video, I'm going to explain why RMDs may not be the ticking tax bomb you think they are. Hey everyone, welcome back. My name is Jake Skellhorn. If we haven't met yet, I'm a certified financial planner and the co-founder of Spark Wealth Advisors, where my partner Chris and I help people retire with confidence and clarity. Let's cover some basics really quick about required minimum distributions. So first and foremost, they only apply to pre-tax individual retirement accounts like IRAs, 401ks, 403bs, 457 plans, and thrift savings plans. And it's basically the IRS's way of saying that you have to start taking money out of these accounts since that money has not been taxed and they want to start earning some of that tax revenue. What a lot of people don't realize is that first year RMD works out to just under 4% of your balance. So it's not like you have to take a massive chunk out of your balance starting at age 73 or 75, depending on how old you are now. Each year that amount will work out to a slightly larger percentage of your balance, but the way it's calculated is taking your year-end balance as of the year before, divided by a life expectancy factor. I'll leave a link in the description below this video where you can take a look at more details on the life expectancy tables that the IRS uses. So the reason that RMDs may not be a big issue for you is if you're relying on that money for income anyway in the form of withdrawals, your IRA balance may not grow to a point where your RMD will put you into a higher tax bracket. So let's take a quick look at two different scenarios of a 60-year-old retiree. One of them has $500,000 in their IRA. The other one has $1.5 million in their IRA. We'll be able to project out what their expected RMDs will be at age 73 and whether or not there will be any issues as a result. All right, so for this example, we're just going to use good old Excel. In the first one, we have, again, a retiree age 60. Their balance at age 60 is $500,000. We're going to assume that they're taking about $20,000 out from their account per year for living expenses. We won't look at any other income sources like Social Security or pensions for the purposes of this example, so just keeping it really simple. But they are going to increase their withdrawal each year for inflation 3%, and then their rate of return for their investments in their account is 6%. So as you can see, their starting balance is $500,000. 6% growth would put them at $530,000. They're withdrawing $20,000, so their next year balance is $510,000. So again, if they need this money anyway to take out for their withdrawals, by the time they're RMD age, their expected balance in their retirement account would be about $631,000. Their first year RMD would only be about $23,833 when they would have needed to take out over $28,000 anyway. So this is one of those situations where an RMD probably wouldn't be a big issue for them. It's not going to put them into a higher tax bracket, again, because they need to take that money out anyway. Now, if we look at a retiree with $1.5 million in their IRA at age 60, and they're taking the same dollar amount as a withdrawal, obviously this is where RMDs can be an issue because it's allowing more of that money to grow and compound so that they're at almost $2.9 million at RMD age. And instead of taking out just $28,000 that they need for their regular expenses, they're forced to take out over $109,000. So again, this is one of those situations where RMDs would be an issue. And this is one of the situations where it's probably not worth converting all of that money to Roth. So basically what it comes down to is, are you going to be withdrawing enough money to limit your IRA balance at RMD age, or is it going to continue to grow and compound to a point where your RMDs would be an issue? So that's the takeaway here. A couple of other reasons why RMDs may not be the devil that you think they are. Number one is that you can make qualified charitable distributions from your IRA starting at age 70 and a half. So if you are someone who's already charitably inclined and you want to donate that money from your IRA that you need to take out as an RMD, you can do this QCD or qualified charitable distribution where you send that money directly from your IRA to a charity of your choosing and you don't realize it as income at all. So there's no taxes associated with that. Once again, this probably only makes sense if you're already planning to donate that money to charity. You might as well do it in a tax efficient manner. But if you're not already charitably inclined, you're basically giving away $1 to save 20 cents. One other thing that comes to mind if you do have an RMD that you wouldn't have otherwise withdrawn anyway is that you could be able to offset some of that tax liability with a tax deduction for qualified medical expenses such as long-term care expenses. So if you have to take out $10,000 from your IRA that you didn't need and now you owe $2,000 in taxes, you may be able to offset that again with a $10,000 medical bill if that is, something that you're spending anyway on long-term care, whatever it might be. So definitely speak to a tax advisor on this one to make sure that you're doing that correctly. But most of us at some point in our life will have long-term care expenses, and those can be tax deductible in some cases. So while RMDs can cause some tax issues for a lot of people who have big balances in those pre-tax accounts, or maybe retire a lot later than the people we use in our example there, they may not be as big of an issue for you as you've been led to think. Like we touched on earlier, this is one of the reasons why Roth conversions may not make sense for you. I did make a video recently with 4 other reasons why Roth conversions may not be appropriate in your situation. If you want to check out that video, here it is now. Besides that, subscribe to the channel and we will see you in the next one.